Over the past couple of weeks, I have been listening to several economists and real estate experts make their predictions for 2023. Despite the doom and gloom coming out of the editorial rooms across the country, not one of them said that they were concerned about the long-term health of the real estate market. The fact is that while we may see some short-term depreciation, over the long haul, real estate is still one of the safest investments there is. Hey, my name is Rich Peterson with Remax Gold in American Canyon, and this is my December 2022 market update and a look ahead to 2023, as the case may be. So first, let's actually take a quick look at where the market is today and really where the market has been over the past year, because it is a tale of two separate markets. There's the market from January through the end of April, the market that was characterized by low inventory and low interest rates, creating a feeding frenzy where tens of buyers were competing against each other, making exorbitant offers in the hopes of finding a home, including offering to name a firstborn after the seller. Unfortunately, she didn't get it. Then came the interest rate crescendo, starting in the middle of April. So at the beginning of January, interest rates stood at about 3.33%. However, starting in the middle of April and by the beginning of May, mortgage rates were solidly over 5%, and it was anyone's guess as to where or when they would stop. As of December 12th, bankrate.com shows a 30-year fixed at 6.52%, basically double of where it was a year ago. This is the fastest increase in interest rates in 50 years since they've started keeping track. This chaotic and dramatic increase has become a significant drag on buyer demand. In fact, at the current pace, top economists are projecting only 5.1 million sales across the country, a drop of almost one-third from last year's 6.9 million. Locally, the drop hasn't been quite as dramatic. 2,759 homes have been sold across southern Solano and Napa County since the beginning of the year. This is only about a 20% decrease from last year, but at a median sales price of $535,000. Although down year over year, it is still up 9.2% from 2020, which had a median sales price of around $485,000. This echoes a common theme since the middle of summer. Units and volume sold are both down year over year, but the overall median sales price is still well ahead of where the market was 2 or 3 years ago. One other trend that I've also been noticing is that the sales price against the list price is decreasing. Currently, homes are being sold at 96% of the list price. Days on market are up 60% from last year and 37% from 2020, so it's taking about 50 days to sell a home right now. Now, historically, that's still a fairly quick market. But what's striking is as of the last report, we're carrying about little over 3 months of inventory. And somewhere, usually, if it takes 3 to 6 months to sell a property, that's a neutral market. But given the nature of today's consumer, we're going to have to probably take another look at that data, or at least the data definitions of what a buyer's market or a seller's market is. Regardless, based on my research and experience, I think we should expect to continue to see a neutral market that we've been seeing over the last quarter, at least through the first quarter of this year. Most buyers have both 2008 and 20, the last couple of years in their mind, so the understanding of a normal market is extremely skewed. The biggest difference in mindset between today and 2008, however, is that when we as sellers are talking to our neighbors who were selling back then, we were concerned about how much money they may have been losing. Today, after 2 years of astronomical gains, we're more concerned that they might not have made quite as much as if they had sold last spring. Right now, the fact is the average homeowner has about $300,000 in equity built up over the past few years. There is no question that the market is desperately searching for stability. I feel a little bit like a town crier, but the fact is that both the first-time buyers and especially move-up buyers need the ability to budget and plan. With continued market volatility, that is extremely difficult. As I mentioned before, when interest rates hit 5% at the end of April, beginning of May, there was a dramatic shift in buyer behavior, as in they stopped shopping. As of this morning, mortgage rates were in the mid-sixes. Where will they be at this time next year? A survey of Freddie Mac, Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors shows varied rates between them, but there's an average of about 6.2% by the end of 2023. This is within like a quarter point, and it's exactly this type of stability that the market is desperately searching for. So overall, expect to see a flatter market across the board. I think, however, that the older starter home prices will continue to fall a little further proportionally, but look for them to really stabilize as mortgage rates fall with inflation. Inflation falls. On average, growth is going to be negligible. Maybe it'll top out about 1% over the next 12 months. There is a phrase that I've been hearing get tossed around a lot since September, and that is downside sticky. Essentially, what they mean is that your home is only going to lose value if you put it on the market. Until then, you've retained that equity. So there are three key indicators that I'll be watching over the next few months. Of course, inflation is a huge deal. Recent reports show it leveling off, which is good news for the mortgage industry. As I've mentioned before, mortgage rates are tied closely to inflation. If the Fed's policy of raising short-term interest rates to cool inflation is successful, that will be good news for a ton of potential borrowers. I'll also be keeping a close eye on unemployment. There have been massive layoffs in the real estate tech sector. It will be interesting to see if this is because companies had bad ideas that failed, or if there really is something larger looming. Patrick Bet David, a best-selling author and entrepreneur, is, as he puts it, paranoid. Well, actually paranoid about everything, but definitely paranoid about a recession and the potential wave of foreclosures that would surely come with it. Although always a possibility, David Childers over at Keeping Current Matters, whom I reference frequently, did cite that fewer than 0.5% of loans are in default. So even if there are a wave of, if there is higher unemployment, it's not looking like we're going to have the same stuff going on. And lastly, I'm going to take a look at new construction. There is an undersupply of homes by about 3 to 5 million units throughout the country, proportionally regionally. And what I'm really going to be looking at locally is the homes, Artisan by D.R. Horton over at Watson Ranch. These are prime move-up opportunities for many of the families who bought in the Rancho Del Mar and Napa Meadows and Napa Square subdivisions in American Canyon from 2016 to early 2020. My prediction, however, is that a lot of the families that may have thought about moving up will stay put because of the higher prices that these homes fetch, the HOAs, Mello-Roos, and tiny yards. However, if interest rates drop, it may be enough to induce pre-pandemic buyers to put their home on the market and see what happens. It would be good for all if we can get this influx of inventory. So down to the nitty gritty, what's really ahead for the Napa Solana region in 2023? Without a doubt, we're going to continue to have sluggish inventory, especially for resale, in particular in American Canyon and Fairfield. I've been squawking about lack of inventory since fall 2019, and there's not enough new construction to make that change. Sales for 2022 are going to be off between 20 and 25% from the last year. Not including Artisan at Watson Ranch, I don't think we'll do much better next year. Interest rates will remain in the 6 to 6.5% range all year, which will help stabilize the local markets. However, I think we will see more starter homes in the mid and upper mid 400,000s, especially if they need any kind of cosmetic work. The mid-range homes in American Canyon will take more of a hit than in other cities because of Artisan. It really will erode some of the gains that homes in Napa Square, McKnight Acres, etc., have made over the past couple of years. But buyers will still be attracted to larger homes, even if some of these homes need a little bit of elbow grease. So really, that's all, except for a reminder to sellers and their agents. You guys are going to have to work hard to get a home sold. More open houses, more video, professional photos, more conversations with potential buyers. Lenders are really going to have to continue to be creative for first-time home buyers as interest rates are going to remain in the low to mid sixes and debt to income ratio remains an issue for a lot of the millennials with student loans, as well as some of our Gen Xers who are also looking to enter the first-time home buyer market. At this time next year, expect home prices to be about where they are now, with increasing buyer and seller activity heading into 2024, when we can expect to start seeing housing prices rise modestly. I hope. Thanks for watching, and I'll be back next week with a lighter look at the numbers. Don't forget that tomorrow is Lunch Bites, where I'll be answering some of the burning questions that have my super fans, or that my super fans pass along. Have a great day.